Silver is $63 until you try to actually buy it. Right now the American Silver Eagle market is flashing a warning most people don't understand: availability is tightening, language is changing, and the spot price is starting to look like a number you can't use. What you're watching right now is the moment the spot price stops being a price you can actually use. Because on paper, silver is sitting in that familiar late 2025 range, roughly $62 to $64. Clean. Tradable. Liquid. A number you can quote at a dinner table. But in the real world, the only world that matters when you're trying to obtain metal, not a screenshot, something far more important is happening. The U.S. Mint is being forced into rationing behavior on its flagship retail product, the American Silver Eagle. And once the U.S. Mint starts acting like a stressed supplier instead of a confident producer, you're no longer in a normal market. You're in the early phase of a retail run. Let's define that clearly, because the word run gets thrown around too casually. A retail run is the precious metals version of a bank run. Not the same mechanics, but the same psychology. The crowd doesn't panic because a collapse is confirmed, the crowd panics because access starts to tighten, and tightening access is the proof that the system is under strain. It starts with whispers. Eagles are a little hard to get. Dealer says 2-week delay. Premiums are a bit higher than usual. Then it becomes allocation language. Limited per customer. Pre-order only. Backorder, no ETA. Call for availability. And then, quietly, the most revealing phrase appears. Temporarily unavailable. That phrase is not a normal retail detail. It is a confession. It means the demand you can see has exceeded the supply you're allowed to access. It means the pipeline is empty enough that the seller is protecting themselves from making promises they can't keep. Now here's the part most people miss. The U.S. Mint doesn't sell Silver Eagles to the public. They sell to a small group of authorized purchasers. That structure exists for one reason: to control distribution and smooth out demand spikes. It's supposed to prevent chaos. So if the market is still experiencing tight availability and rationing behavior even with that buffer system in place, then the stress is not cosmetic. It's structural. Because the Silver Eagle is not a niche collectible. It's the retail benchmark. It's the product that tells you what the average, everyday buyer is doing when they finally stop trusting the story and start demanding the thing. And when everyday buyers start demanding the thing, the physical market does something the paper market cannot do: it runs out. That's the core problem we're dealing with in this video. A paper price can trade forever, because paper can be created forever. A physical price can't, because metal has a hard limit. You either have the coins, or you don't. You either have blanks, refining capacity, logistics, and production slots, or you don't. You either have inventory on the shelf today, or you're selling a promise. So when people tell you, silver is $63, your next question should be: where? And in what form? Because there are now two markets pretending to be one. Market number one is the screen price: futures, swaps, unallocated, synthetic exposure, an ocean of claims that can be expanded with a keystroke. Market number two is the acquisition price, the amount of dollars it takes to obtain immediate deliverable physical metal in a form people actually want, like a U.S. Mint coin that is universally recognized and instantly liquid in the retail world. And this is where the tension becomes explosive. When the U.S. Mint cannot feed the pipeline smoothly, dealers don't have to raise the price out of greed. The price rises because inventory becomes a rationed resource. The premium is not a markup in the moral sense. In a shortage, the premium is a signal flare. It's the market's way of saying, you can keep quoting the spot price, but spot is not clearing real demand. Premiums are the lie detector. In a calm market, premiums behave like a service fee. They cover fabrication, distribution, hedging costs, and a modest profit margin. In a stressed market, premiums become the true auction mechanism. They become the real-time bid for scarce availability. And that's why you can have a situation where silver is down today on a chart, while real buyers are paying more than ever for eagles. Think about how absurd that is, and then realize it's not absurd at all. It's exactly what a split market looks like right before the public finally understands what's been happening for years. The mainstream will explain it in harmless language. Strong demand. Production constraints. Temporary supply disruption. But the physical market is explaining it in a much more honest language. Pay up, or wait. And waiting is not neutral anymore, because the psychological shift is already in motion. A retail buyer who wants silver eagles is usually not trying to outperform a hedge fund. They're trying to secure something tangible in a world that feels less stable by the month. They want a unit they can hold, count, verify, and trade. That buyer doesn't care about sophisticated narratives. They care about one thing: availability. So once those buyers feel scarcity, they don't back off. They accelerate. They buy more, sooner, and they stop waiting for pullbacks that may never show up at the retail level. This is how runs start. Not with headlines. With empty shelves. With rising premiums. With dealers changing their tone from, "Sure, no problem," to, "I can't guarantee delivery." And yes, there are practical reasons the mint can tighten supply. Manufacturing is not magic. Coin production requires planchets, minting capacity, labor, scheduling, and logistics. Any bottleneck in that chain can reduce output. But the deeper issue isn't whether the mint has a good reason. The deeper issue is what rationing reveals about the overall market balance. If the system was truly well supplied, a demand surge would be met with product flow and stable premiums. If the system is fragile, a demand surge triggers rationing, delays, and a premium explosion. And late 2025 is a textbook fragile environment. Silver isn't just a precious metal right now. It's an industrial survival input. It is being pulled by solar expansion, electrification, grid upgrades, defense electronics, high-performance computing, and a tech race that does not slow down just because the average consumer is stressed. At the same time, retail investors, the smallest players, are waking up to a simple reality: if you can't print purchasing power without consequences, then you can't assume your savings will be safe just because it's denominated in dollars. So retail demand rises for the most recognizable, trusted products, government-minted coins. That means eagles. And the eagle market is where the paper versus physical conflict becomes visible to normal people without any technical knowledge. You don't need to understand derivatives to understand a sold-out sign. That's why this rationing matters so much. It's not just a coin story. It's a confidence story. Because when the US Mint, the symbol of official supply, the public face of, "we can meet demand," can't keep product flowing smoothly, it sends a message that is the opposite of calm. It tells buyers, if you want certainty, you need to act before the next restriction hits. And here's the trap that catches people who wait too long. When premiums rise, many people assume premiums will fall again because they always do. But during a retail run, the premium isn't merely a temporary spike. It's the market repricing immediate availability. And once the retail crowd accepts that the real price is the physical acquisition price, the spot price becomes a reference point, not a transaction point. That's when FOMO becomes rational, not emotional. Because a buyer isn't chasing a chart anymore. They're chasing access. And access tightens in steps, not in a straight line. One week it's a limit per customer. Next week it's, no eagles, but we have generic rounds. Then it's, no rounds either, but maybe 100 ounces bars, if you wire today. Then it's, call back next week. And each step rewires the buyer's brain, they stop believing supply is normal. Now, I want to be very specific about what the problem is for the average person watching this. The problem is not simply, silver is going up. The problem is that the market is beginning to teach you, in real time, that there is a difference between owning exposure and owning metal. If your entire understanding of silver is a number on a screen, you are living inside market number 1. But if your goal is to convert currency into a real asset you can hold outside the banking system, you have entered market number 2. And market number 2 is where rationing is reality, premiums are the message, and delays are the warning. So the key question becomes brutally simple. If the US Mint is tightening Silver Eagle availability while the screen still says $62, $64, what happens if the screen price starts moving again? Because when paper momentum returns, it doesn't just raise the spot price. It detonates retail demand. And retail demand hitting a ration pipeline is how premiums go vertical. That is why this isn't a cute collector story or a temporary inconvenience. It's the opening phase of the retail run, where the shelves teach the lesson that charts try to hide. And from here, the only thing that matters is how fast the public connects the dots between a paper price and an empty shelf.